You know what's fascinating? While everyone's glued to their stock portfolios watching the S&P bounce around, there's this massive shift happening that almost nobody's talking about. And I mean massive. We're talking billions of dollars quietly rotating out of equities and into one specific asset: silver. Now, before you think this is just another precious metals hype piece, let me show you something that'll make your jaw drop. In the last 90 days, institutional investors have pulled over $47 billion out of equity positions. That's not speculation, that's SEC filing data. But here's where it gets interesting. During that exact same period, silver ETF holdings jumped by 89 million ounces. That's not retail investors buying 1-ounce coins. That's smart money making a calculated move. And they're doing it for reasons that should terrify anyone holding a traditional 60-40 portfolio right now. Let me paint you a picture of what's actually happening in the markets. You've got the S&P trading at a Shiller PE ratio of 31. For context, that's higher than it was before the dot-com crash, higher than 2007 before the financial crisis. The only time it's been higher was literally right before the tech bubble exploded. So you've got stocks at nosebleed valuations while corporate earnings are starting to roll over. Third quarter earnings growth came in at 4.3%, down from 8.1% the quarter before. The trend is not your friend here. Meanwhile, silver's sitting at $31 an ounce, and that number is absolutely absurd when you understand what's happening in the physical market. The silver deficit, the gap between how much silver we mine and how much we actually use, hit 215 million ounces last year. That's the second largest deficit in recorded history. In 2025? We're on track to blow past that number. The Silver Institute is projecting a 265 million ounce deficit this year. Think about that for a second. We're consuming 250 million more ounces than we're producing, every single year. And unlike gold, which mostly just sits in vaults looking pretty, silver gets used up. It goes into solar panels and gets installed on rooftops. It goes into electronics and ends up in landfills. It goes into medical applications and literally gets consumed. Gone. Forever. But here's what really keeps me up at night. The stock market's entire valuation is built on this assumption that interest rates are coming down, that inflation's beaten, that we're heading into this Goldilocks economy. And smart money? They're looking at the same data and calling nonsense. Let me show you why. The Fed's balance sheet is still sitting at $7.2 trillion. For perspective, before 2008, it was under $900 billion. They've barely made a dent in unwinding all that money printing. And now, with regional banks still wobbly, with commercial real estate imploding, with the government running $2 trillion deficits, you really think they're going to be able to tighten significantly? The bond market's already telling you the answer. The 10-year yield keeps spiking every time the Fed tries to sound hawkish. And this is where silver becomes absolutely critical. Because unlike stocks, which need a perfect economic environment to justify these valuations, silver thrives in chaos. It's an industrial metal, so it benefits from the green energy transition that's happening regardless of economic conditions. It's a monetary metal, so it benefits when people lose faith in paper currencies. And it's in structural deficit, so it benefits from simple supply and demand mathematics. I was talking to a fund manager last week who runs a $3 billion portfolio. This guy's been in the game for 30 years, managed money through multiple crashes. And he told me something that stuck with me. He said, "I've never seen a setup like this. You've got an asset that's essential for the energy transition, that's in massive supply deficit, that's historically undervalued relative to gold, and that nobody owns. It's like finding a winning lottery ticket that everyone threw away because they didn't recognize the numbers." And he's right about that last part. Nobody owns silver. The average portfolio allocation to precious metals is under 1%. Most people have zero exposure. Meanwhile, the average stock allocation is over 60%. So you've got everyone crowded into overvalued equities, while this massive opportunity in silver sits there completely ignored. But smart money's not ignoring it anymore. Let me give you some specific examples of what's happening. Sprott Physical Silver Trust, one of the largest silver ETFs, has seen inflows of $890 million in the last 6 months. That's more than the previous 2 years combined. The SLV, the biggest silver ETF, added 47 million ounces in the last quarter. These aren't small numbers. This is institutional-sized money moving. And it's not just ETFs. Look at what the mining companies are doing. First Majestic Silver just announced they're holding silver production off the market. They're literally mining silver and keeping it in inventory, rather than selling at current prices. When was the last time you saw a mining company do that? They're in the business of selling metal. If they're holding back supply, they know something about where prices are headed. Or look at what's happening in the physical market. Premiums on silver coins and bars have been running 15 to 20% above spot price for months now. That's not normal. In a healthy market, premiums run 3 to 5%. When you see premiums this elevated for this long, it means there's a massive disconnect between the paper price and the physical reality. It means the price you see on your screen doesn't reflect what people are actually willing to pay for real metal. And here's where the stock market connection becomes crystal clear. Every major market crash in history has been preceded by smart money rotating out of overvalued assets and into hard assets. 1929? The Homestake Mining Company, a gold miner, was one of the only stocks that went up during the Depression. 1987. Gold and silver bottomed in July and started rallying 3 months before Black Monday. 2000. Precious metals bottomed in 1999 and began a decade-long bull market while the Nasdaq crashed 80%. 2008. Gold peaked at $1,000 in March 2008, pulled back, then went on to triple while stocks went nowhere for years. The pattern is always the same. Smart money sees trouble coming. They start rotating out of overvalued paper assets. They move into hard assets that can't be printed or inflated away. And by the time the crash happens, they're already positioned. So what's different this time? The scale. We've never had stock valuations this extreme while simultaneously having a hard asset in structural deficit. We've never had this much money printing while having an industrial metal that's essential for the energy transition. We've never had this perfect storm of factors all pointing in the same direction. Let me break down the math for you, because this is where it gets really interesting. Silver's currently trading at a gold-to-silver ratio of about 84 to 1. That means it takes 84 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages around 60 to 1. During periods of economic stress, it's dropped as low as 30 to 1. In ancient Rome, it was 12 to 1, because that roughly reflected the ratio of silver to gold in the Earth's crust. So if you believe gold's going higher, which most people do given the debt situation and geopolitical tensions, then silver should go dramatically higher just to normalize that ratio. If gold hits $3,000 and the ratio drops to 60, silver's at $50. If the ratio drops to 40, silver's at $75. And those aren't crazy numbers. Silver hit $50 in 2011 when the deficit was smaller, when solar demand was a fraction of what it is now, when industrial demand was lower across the board. But here's what really blows my mind. The entire above-ground investment silver market is worth maybe $50 billion. That's all the silver in ETFs, all the coins and bars in private hands. Everything. For comparison, Apple's market cap is $3.5 trillion. The entire investable silver market is 1.4% of one company. If just a tiny fraction of stock market money rotates into silver, the price impact would be astronomical. And that rotation is already starting. I'm seeing it in the options market. Call option volume on silver miners has exploded. The put-call ratio on SLV has flipped bullish for the first time in years. These are technical indicators that show you where the smart money's positioning, and they're all pointing the same direction. Now, quick aside here because this is relevant for a lot of people watching. If you're sitting on $100,000 or more in retirement accounts, you might want to look into how gold and silver IRAs work. I put together a free guide that covers the mechanics, how to move money without tax penalties, what the rules are. It's in the description. Not trying to sell you anything, just information that might be useful given what's happening in the markets. Anyway, back to why this matters right now. The thing about market rotations is they happen slowly, then all at once. You get months of quiet accumulation where smart money's building positions. Then something breaks, everyone realizes what's happening, and the move becomes violent. We saw it with GameStop. We saw it with crypto in 2020. We saw it with housing in 2005. The pattern is always the same. And we're in that quiet accumulation phase right now with silver. You can see it in the data. Commercial traders on the COMEX, the guys who actually use silver in their businesses, have reduced their short positions to the lowest level in 5 years. That's huge. These are the people who hedge their physical silver needs by shorting futures. When they're covering shorts, it means they're worried about availability. It means they think prices are going higher and they want to lock in physical supply now. Meanwhile, the big banks that used to dominate silver shorting have basically exited the market. After getting hit with massive manipulation fines, after years of investigations, they've stepped back. JP Morgan paid $920 million in fines for spoofing the silver market. They're not eager to get caught doing it again. So you've got less artificial selling pressure than any time in the last decade. And on the demand side, it's accelerating. Solar panel installations are projected to double by 2030. Every panel uses about 20 grams of silver. That's 200 million ounces of new annual demand just from solar. Electric vehicles use twice as much silver as regular cars. EV sales are growing 30% year over year. 5G infrastructure uses 10 times more silver than 4G. The rollout is just beginning. This isn't speculative demand. This isn't people buying silver hoping it goes up. This is industrial consumption that's baked into the energy transition, into the technology upgrade cycle, into the infrastructure spending that governments around the world have already committed to. It's happening regardless of what the stock market does. But here's where the stock market crash scenario becomes really important. Because in a normal environment, you might see silver grind higher over years as the deficit plays out. But if stocks crash, if we get a 2008-style panic, that's when silver goes parabolic. Let me explain why. In a crash, the Fed has to respond. They have to print money, cut rates, do whatever it takes to stabilize the system. We know this because they've told us. Powell said explicitly that the Fed will do whatever's necessary. So a stock crash doesn't mean deflation anymore. It means massive monetary stimulus. And that's rocket fuel for precious metals. Look what happened in 2020. Stocks crashed in March. The Fed immediately printed $4 trillion. Gold went from $1,500 to $2,100. Silver went from $12 to $30. It more than doubled in 5 months. And that was with silver starting from a much higher base than where we are now relative to the deficit situation. Now imagine that scenario playing out with silver already in massive deficit, with industrial demand surging, with investment demand starting to wake up. You could easily see silver triple or quadruple from current levels. And I'm not being hyperbolic. In 1979-1980, silver went from $6 to $50 in less than a year. In 2010-2011, it went from $17 to $50 in 8 months. These moves happen fast when they happen. And here's the thing that keeps me up at night. The stock market's giving us warning signs everywhere. Insider selling is at record levels. CEOs are dumping their own stock at a pace we haven't seen since 2007. The Buffett indicator, market cap to GDP, is at 205%. Anything over 120% is considered overvalued. We're in nosebleed territory. Corporate debt is at $10.5 trillion, up from $6.5 trillion in 2019, and a huge chunk of that debt was issued at ultra-low rates that are now rolling over into much higher rates. Companies are going to have to refinance into 7-8% rates when they were paying 3 to 4%. That's going to crush earnings. It's going to force defaults. It's going to create a credit crisis. And when that happens, when the cracks start showing, smart money's already going to be positioned. They're not going to wait for CNBC to tell them to buy silver. They're doing it now, quietly, while prices are still reasonable and supply is still available. I was looking at the COMEX warehouse data last week. Registered silver, the stuff that's actually available for delivery, is at 42 million ounces. That sounds like a lot, until you realize that's only $1.3 billion worth of metal, backing a derivatives market with over $100 billion in notional value. It's a joke. If even a small percentage of paper silver holders demanded physical delivery, the whole system would break. And we're seeing signs that's starting to happen. Delivery notices on COMEX silver contracts are up 340% year over year. People are standing for delivery instead of rolling contracts. That's not normal. That's what happens when people lose faith in paper promises and want real metal. The same thing's happening in the retail market. Go try to buy 1,000 ounces of silver from a major dealer. You'll wait 4 to 6 weeks for delivery. That's not because dealers are lazy. It's because the mints can't keep up with demand. The U.S. Mint sold 18.7 million Silver Eagles in the first half of this year. That's already more than all of 2022. And we're seeing the same pattern globally. The Perth Mint, the Royal Canadian Mint, they're all running behind on orders. This is what a supply squeeze looks like in its early stages. Premiums rising, delivery delays extending, physical tightness while paper prices stay suppressed. And then one day, the paper price catches up to physical reality, and it happens violently. You want to know what really convinced me this is different? I was talking to a bullion dealer who's been in the business for 35 years. He told me he's never seen anything like the current market. He said in 2008, people were selling silver to raise cash. In 2011, people were buying silver to chase momentum. But now, he's seeing a different type of buyer. Wealthy individuals, family offices, people who've made money in stocks and are quietly diversifying. They're not buying to flip it. They're buying to hold it. They're treating it like insurance. And that's exactly what smart money does before a crash. They don't wait for the crash to buy insurance. They buy it when it's cheap, when nobody else wants it, when the market's complacent. Then, when the crash happens, they're protected while everyone else is panicking. The correlation between stocks and silver has been breaking down over the last 6 months. Normally, when stocks sell off, silver sells off too because it's seen as a risk asset. But lately, we're seeing days where stocks drop and silver rises. That's a huge tell. It means silver's starting to trade like a safe haven rather than a risk asset. It means the market's recognizing its monetary properties, not just its industrial uses. And this makes sense when you think about what's happening globally. Central banks bought 1,037 tons of gold last year, the most since 1967. They're diversifying away from dollars. But gold's expensive and hard to accumulate in size without moving the market. Silver's the poor man's gold. It gives you precious metal exposure at a fraction of the cost. And for countries trying to build reserves without attracting attention, silver's perfect. We're also seeing the BRICS nations talking about a commodity-backed currency. Whether that happens or not, the fact that they're discussing it tells you where the world's heading. Away from pure fiat currencies, toward hard asset backing. And silver, with its dual role as industrial and monetary metal, fits perfectly into that framework. The geopolitical situation is accelerating this trend. You've got the U.S. weaponizing the dollar through sanctions. You've got countries looking for alternatives to SWIFT. You've got trade wars and supply chain fragmentation. All of this pushes nations toward hard assets that can't be frozen or sanctioned. Gold and silver become strategic reserves, not just financial assets. And here's where the stock market vulnerability becomes critical. The entire bull market since 2009 has been built on cheap money and financial engineering. Companies borrowed cheap money to buy back stock. Private equity borrowed cheap money to do leveraged buyouts. Everyone levered up because money was free. But now, rates are higher, and that whole model breaks. The buybacks stop. The deals stop. And without that artificial bid, what holds stocks up? Earnings sure aren't going to do it. Profit margins are at record highs, which means they have nowhere to go but down. Labor costs are rising. Input costs are rising. Pricing power is fading as consumers tap out. The margin compression is just beginning, and it's going to be brutal. Meanwhile, silver benefits from all of this. Higher labor costs? Doesn't matter. Silver's already cheap. Inflation? Silver's a hedge. Recession? Silver's industrial demand is locked in through government infrastructure spending. There's no scenario where silver doesn't work from these levels. And the technical setup is perfect. Silver's been consolidating for 3 years, building a massive base. Every time it's tested $30, it's held. That's not random. That's smart money accumulating. They're not letting it break down because they're building positions. And once this base breaks out, once silver clears $35, there's nothing but air above it until $50. The options market's telling you the same story. Implied volatility on silver is still relatively low, which means options are cheap. Smart money's loading up on call options, giving them leveraged exposure to a breakout. When that breakout happens, the gamma squeeze could be massive. We saw what happened with GameStop when options dealers had to hedge. Imagine that dynamic in a market that's already in structural deficit. I keep coming back to this one fact that blows my mind. The entire silver market is tiny. Global silver production is about 830 million ounces per year. At $31 an ounce, that's $25.7 billion. That's less than the market cap of Chipotle. The entire annual silver production of planet Earth is worth less than a burrito chain. If even a small fraction of stock market wealth rotates into silver, the price impact would be extraordinary. And that rotation is starting. You can see it in the fund flows. You can see it in the ETF holdings. You can see it in the premiums. You can see it in the delivery demands. All the signs are there if you know where to look. Smart money's not waiting for confirmation. They're acting now, while prices are still reasonable. The question isn't whether silver's going higher. The deficit math alone guarantees that. The question is whether you're going to position before the crowd figures it out, or after. Because once this move starts, once silver breaks out and the momentum traders pile in, you won't be buying at $31 anymore. You'll be chasing it at $45, at $60, at $80. And if stocks crash while this is happening, if we get that perfect storm of equity market panic and precious metals mania, silver could easily see triple digits. I'm not saying that to hype you up. I'm saying it because the math supports it, the deficit supports it, the historical precedents support it, and most importantly, the smart money positioning supports it. They're dumping stocks for silver right now because they see what's coming. They see the overvaluation. They see the debt bubble. They see the deficit. They see the supply squeeze. And they're acting on it while everyone else is still complacent, still believing the stock market can only go up, still thinking precious metals are a relic of the past. But here's the thing about markets. They don't care what you believe. They care about supply and demand. And right now, silver's supply and demand fundamentals are the most bullish they've been in decades, while stock market fundamentals are the most bearish they've been since 2000. Smart money's reading the same data you have access to. They're just acting on it, while others are still in denial. The rotation is happening. The only question is whether you're going to be part of it or watch it happen from the sidelines.